Thank you, Fiona. I have to confess I've been pretty nervous about this presentation. There's a lot of people in the room. This is a really, really important point, 10-year anniversary. I'll talk about that in a minute. And it reminds me of the last speech I had to give that I was this nervous. I was doing a speech with Al in Berlin, and we were speaking at the Absolute Return Conference, which is a private equity hedge fund conference that's quite significant in Europe. And the fact that Generation was invited was, in and of itself, a pretty remarkable thing. So anyway, I was a little nervous. And I made the mistake of texting my daughter and telling her that I was a little nervous. And of course, instantly, I got a response back, because apparently when you text, you're supposed to respond immediately, no matter what you're doing. And she said, "Dad, get over yourself. No one is going to be listening to you. They're only going to hear Mr. Gore." I felt much better. I texted Alexis this morning to tell her I was here, and she said, "Same thing, just remember it." And so I think I'll be okay. It's almost 13 years ago to the day that I announced that I was retiring from Goldman Sachs. And I told my partners that I was going to establish with some others a sustainable investing firm. And they said to me that I was crazy, and that this, in fact, confirmed what they always thought about me, that I was crazy. And a lot has changed in these last 13 years, or indeed these last 10 years. First of all, you all are here, which is terrific. We have half of the largest investment managers in the world are represented in this room today. Many more of the largest asset owners in the world are represented here today. It's difficult to pick up a newspaper without seeing some kind of article around sustainability, ESG, responsible investing, either from an asset manager, an asset owner, or importantly, businesses themselves, talking about why sustainability matters to their long-term success. We have accomplished a lot. You all have accomplished a lot. And I think the reason we have done so is that the business case for thinking about sustainability, about integrating sustainability into investment processes, is very robust, and it's all about economics in the end. And increasingly, the academic research over these last 10 years confirms that. So we are off to a very, very good start. So what I thought I would do this morning is remind us all of what that business case is, that framework, talk a little bit about what Generation has learned, and then maybe conclude with 5 steps that I think we collectively need to take over the course of the next 5 years or so. The context or the framework around sustainable investing rests on 2 points. First, a macro point, that drivers of change, sustainability factors, whether it be environment, climate change, poverty, water, health, demographics, inequality, these global challenges are becoming more intense, more significant, and therefore much more relevant to business. And incidentally, these issues are interlinked, and you can't really separate them anymore, which makes them even more complicated and more relevant. So that's the backdrop that businesses are operating and investors are operating in today. And then on a company-specific basis, it's rests upon reputation, brand as sort of a first pillar. It rests upon resource management and managing climate change, but resources in particular. And it rests upon opportunities to use sustainability as a competitive advantage to drive revenues, profitability, and competitive positioning. What we've discovered over the last 12 years is that both the macro backdrop of thinking about sustainability is an extremely important first step to an investment process, and that secondly, the integration of sustainability into investment processes, investment philosophies, is best practice. And I would say today, while people may not necessarily use the word sustainability, They will certainly acknowledge that reputation management, as an example, brand management, is extremely important. If you dump a lot of oil into the Gulf of Mexico, that's going to be bad for your stock price. If you lie to people about your emissions and your miles per gallon, objectives or cars, that's ultimately going to be a bad outcome for your stock price and your business. So reputation clearly matters, and I don't think anybody disputes that. That is also true for resources, climate change, but resource management. We are living in a world today where resources are becoming constrained, and it's clear that businesses that minimize the use of resources and maximize the resources that they have will ultimately result in better businesses, and that drops to the bottom line. That's actually been known very clearly for 10, 15 years. What's increasingly interesting are investing in businesses that are using sustainability, whether it be environmental challenges or social objectives or governance, to drive profitability and competitive positioning. And there are plenty of examples, not just green examples, social examples, businesses that are recognizing that they can attract and retain their employees in a more robust way that results in better cultures and better businesses as examples. So ultimately, we categorically believe that the integration of sustainability makes us better investors. We think the business case is clear, it's robust, we need to keep going back to it. But if it is clear and it is robust, by extension, we have a fiduciary duty to integrate sustainability into our investment processes and into our investment philosophies. And that is a critical point. The more we can make the point, the more we prove the business case, the more it is an obligatory responsibility of asset owners and asset managers to use sustainability, to integrate sustainability into investment processes. In fact, that initiative will make responsible investing no longer something different. It will make it mainstream, and we must move to that for sure. So sustainable investing is a framework. It helps us make better investment decisions, and we think it's best practice. Now, I would say that there are 5 things we collectively need to do over the course of the next 5 to 10 years. The first is we do need to win the battle, win the discussion, win the debate on fiduciary duty. There are still many investors, most of whom are in the United States, my home country, who will still claim that fiduciary duty precludes them from thinking about sustainability or integrating sustainability into investment processes. That's wrong. We know that's wrong. That's why we're here. We know that's wrong. Our investment results, academic evidence says that it's wrong. We need to make that case very clear. And the work that the PRI and others are doing on this, that Fiona mentioned, is a critical step in that. Secondly, we need to change the debate from why integrate sustainability to how do you integrate sustainability into investment processes. And we need to do a better job of improving and enhancing and making more robust the ecosystem, the infrastructure of sustainable investing. That's about reporting. That's about fiduciary duty also. It's about actually increasing the number of firms, asset managers, who are actively integrating sustainability into their investment processes. And oh, by the way, it's not just equities. Almost every asset class has sustainability as a critical component to its long-term success. The third thing we need to do, actually, is to get the other 50% of asset managers, the largest asset managers, in this room. We're very good at convening those of us who agree. What we need to do in the sustainability world is actually reach out much more aggressively to those who don't yet agree. And let's work on making the business case consistently to those folks, and let's think about the next 5 years from now and how we can get more of them into this room. And by the way, the asset owners among you, you will be critical in that objective. Fourth, the transition to low-carbon economy is a big deal. It will be the most significant economic transition in history. It has to happen now. If we're still talking about the transition to low-carbon economy in 10 years' time, we will have missed it. We must make this urgent, and we need to get on it now. There are two initiatives that will be discussed over the next day and a half. One is the Task Force on Climate Change Disclosure. That is a critical initiative around trying to make disclosure for climate change risks and opportunities much more adapted, much more frequently adapted, and if we can get consistency of data around the world, we can probably begin to actively think about climate change much more aggressively across all of our investment portfolios. It's really important that we get this right. And then secondly, which will be actually discussed here in a few minutes, is the Green Finance Initiative. It is critical that we find ways to mobilize capital to the transition to a low-carbon economy, and we need to do this quite urgently. As I said, if we're talking about this in 10 years or even 5 years, if we haven't significantly moved the needle, we will be in trouble. And lastly, we need to recognize that finance and capitalism is not working for everybody. It is clear that there is significant inequality and that populations and people and voters are upset about it. They feel fundamentally that finance and capitalism and business is not working for them. Unless we all decide that we're immune to that, I want to tell you that just because we think about sustainability and we integrate sustainability in investment processes and we think we're part of the force for good, most of the people in the world have no idea. We are very close to losing our license to operate in finance and in business, and we better get on this very, very quickly. So before, I guess as a conclusion, I'd just like to say very categorically, responsible investing, sustainable in capitalism is best practice. The business case is clear, it's robust, and it's getting stronger. Because of that, it's our fiduciary duty to incorporate sustainability into our investment processes. And by the way, ultimately that results in better investment results. And by the way, it's also common sense. Thank you very much.
Thanks, David. We've got some time for some questions, and I think we've got a microphone, someone roving around with a microphone out there. Well, there's a question over here. Just while we're getting there, though, you talked about the US, and definitely for the PRI, we find it incredibly difficult to get a lot of traction in the US market. We've got some great signatories in the US, you know, CalPERS and CalSTRS, etc. But you know, why do you think it is just so difficult to be able to convince people about responsible investment in the US market? And have you got a tip for us?
What's that?
Have you got a tip for us about cracking that market?
Well, it does concern me that when I actually looked at the top 25 asset managers in the world, I did notice that 50% are here. Most of those who are not here are American. And that speaks to your point. And I think the reason is that fundamentally still in the United States, sustainability, responsible investing is considered a political agenda, and that it's not really serious investing. And that's why we need to absolutely, first of all, we need to make the business case that sustainable investing is best practice, long-term investing is best practice, and by extension, that's our fiduciary duty to incorporate sustainability. We have to focus, though, on the business case. If we just make the case that it's the right thing to do, which incidentally it is, we won't win the argument.
Terrific. Okay, I think there's a question over here. If you can introduce yourself and where you're from, that would be fantastic.
Hi, yes, I'm Anthony Hobley, Chief Executive Officer of the Carbon Tracker Initiative from London. David, thank you for an excellent presentation. As you found through your investment strategy and we found through our financial analysis, you know, there's a lot going on in the financial markets that clearly doesn't make climate or sustainable sense, but actually doesn't make financial sense. So I guess, you know, my question is, why does it take philanthropically funded, I guess, financial analysts like Carbon Tracker to sort of spot that? Why aren't the sort of mainstream financial analysts in the financial system actually doing the sort of analysis that uncovers, you know, many of the, for example, oil, gas, and coal projects that are, you know, sucking in billions, if not trillions, of dollars that actually, let alone not making climate sense, don't make financial sense?
Well, it's a fair question, and I think it would be remiss of me to say to not recognize the great work that Carbon Tracker has done. And there are a number of organizations that have supported Carbon Tracker and have really made a difference. And the whole conversation around stranded assets has come a long ways in 5 years' time. That's the good news. And I think a further bit of good news is that increasingly financial analysts get that. For a long while they didn't, but there's no question that that mainstream investors are now recognizing that climate is a real risk. That's part of the task force on climate change disclosure. That's part of what we're talking about. I know that this is controversial because there's two sides to the story, but the report that BlackRock has put out in the last couple of days is a big deal. They are the largest investment manager in the world, and they are very clearly talking about both fiduciary duty and the fact that climate change matters to investment portfolios. I wish they would vote in different ways too, but the point is that is a major step, and the investment, or sorry, the research community will understand that as well.
Okay, there's a question over here as well.
David, Michael Walsh, UCA Funds Management in Melbourne, Australia. I'd like to hear more about the licence to operate issue. My observation is most sustainability researchers would rate financial institutions, global financial institutions, quite highly on sustainability. My observation is that the sustainability units are small units within organisations working on external companies but not doing much on really enhancing sustainability culture within their own organisations. Just looking for a comment on that.
To be honest, I didn't quite hear your question very well. I'm sorry.
Just on your last point about we're at the edge of losing our licence to operate, but our research suggests that the sustainability performance of major financial institutions is very strong. So there appears to be a mismatch there. I'd like to hear more about the reputational issue facing major financial institutions and what we need to do about it within our own organisations.
Well, by the way, my daughter would also tell me that I'm deaf, which is why I had to get up, so I'm sorry about that. What I meant really there was most people outside of finance actually cannot differentiate between asset managers, hedge fund managers, investment bankers, pension funds, asset owners, et cetera. We're all lumped in the same bucket. And that bucket isn't exactly a great one to be in. People believe that we're not working for their best interests. And so what we need to do, I think very clearly, is we do need to put the social aspect of sustainability front and center in our work. I think we've done a very good job so far on governance and a very good job so far with the environment, though we need to do better on both. But on the social side, we need to do a better job. We need to think about maybe impact investing as an extension of some of our work, and we clearly need to encourage companies to be more responsible long-term in how they think about social issues.
Okay, there's a question here.
Colin Tate from Connexus Financial, based in Sydney, Australia, owner of Top 1000 Funds. David, thank you for your comments. I think you should go back to your original brand of blood and gore rather than generation, but that's a separate issue. Could you please speculate on the result in November of a new president for the free world and what that will mean for sustainable investing in this ongoing debate?
I think Malcolm Turnbull is doing a great job, isn't? Yeah. By the way, we decided we retired the blood and gore joke after 10 years. We felt like that nobody laughed anymore, so I should have used it, darn. To be really honest, obviously I have no idea what is going to happen in the election in the United States. But what I do know, and it was very clear after the results of Brexit, that we are in a period where people are really quite upset, and they feel that the elites, whoever they are, but those of us who are in senior roles around the world, are not operating in a way that's fair, transparent, or responsive to their challenges. And we better that's really the point I'm trying to make with that fifth point, is we better get on that. Because if we don't, we're going to see capitalism rolled back. We're going to see a lot of what has been very successful over these last few years hurt. And very importantly, the challenges of climate, as well as inequality, as well as the broad array of health issues, et cetera, will not be addressed. We need to do this in a coordinated and joint fashion. Putting up walls are not going to help us, for sure. So I guess that's a long way of saying, whether Donald Trump wins or not, we're doubling down on sustainability. We need to be there. All of us in this room are going to need to step up what we're doing over the next 3 to 5 years, regardless, because the challenges we face are just too significant. We can't let it wait, whoever's in power.
Yes, although Donald has said that he's cancelling climate change, so if he becomes president, so we might all be able to just pack up and go home because it's cancelled, it doesn't happen anymore. Simple as that. So as a final question over here, down the back here.
And hopefully this is less political, but I'm not sure. Hi David, Sarah Clausen from New Forests. Thank you for your list of 5 things that we need to do. You say transition to the low carbon economy is a big deal and it has to happen now. I completely agree with you. My question is, what can we do to encourage asset owners to look more towards the opportunities and the positives that they can invest in, rather than just excluding or going away from what might have been or is still a carbon heavy portfolio? Thank you.
Thank you. That's a great question, and I guess it's fair to say, though, that understanding, the first step would be for all asset owners and all asset managers is to understand the carbon exposure, carbon risks that they have in their portfolios. There's no question about that. But what's different today versus 2012 or 2013 is the example of great businesses that are part of the solution and part of the transition to a low carbon economy. They're increasing. And I think a lot of asset owners, in fact, I know a lot of asset owners were quite disappointed, quite frustrated by the results of sort of the first round of green investing or investing in the transition to low carbon economy. We've righted that. I think what we've done is recognize that just because there's a long-term trend doesn't mean we should throw out the fundamentals of finance, to throw out the fundamentals of business. Barriers to entry, pricing power, all these things matter. But the good news now is that I guess first of all, we have Paris, and that's a big deal. But secondly, the example of businesses that understand that are in fact delivering interesting products and services are quite significant and quite many. That said, and we're going to talk about it here in a few minutes, we don't have nearly enough capital at this point in the transition to a lower carbon economy. We have to do a much better job there, and we need to continue to, I think, broaden what we mean by the transition to a low carbon economy. It's not just alternative energy. Everything we've done today will change, and we need to be investing in all aspects of decarbonizing the economy.
Okay, well, sadly, we've run out of time. I think we could have kept talking about this issue for a long time. We're going to continue talking about fiduciary duty, though. Again, I'd really like to thank David, and I'd really like to thank Generation Foundation for all the support that they've given to PRI and UNEP in helping us really to try and solve this problem about fiduciary duty, which is a bit of a key to taking sustainability issues forward. So please join me in thanking David.